Good afternoon, ladies and gentlemen. This is a panel on building digital public infrastructure, a case for digital public infrastructure and mainly focusing on the role that BankServAfrica has done. It's one of the panels that comes very instructive after the previous discussion on cross-border payments. BankServAfrica is the institution that has been mandated by the Reserve Bank, the Central Bank of South Africa, to facilitate national payments in South Africa. So for that, allow me to introduce you Mr. Sarel. Mr. Sarel from BankServAfrica is a strategic research officer and Africa Strategic Business Development Officer for BankServAfrica. As a business and strategy management consultant, Sarel has worked in a range of industries. He has multiple degrees and is also an accredited chartered certified accountant. He joined BankServ in 2018 and is responsible for multiple verticals in BankServ. Most prominently, he was a lead designer for the cross-border payment system currently running in BankServ, that is transactions cleared on an immediate basis, also known as TCIB, and most recently headed the strategy development for BankServAfrica, development for the TCIB mobilization and effort growth. But that's what is just on the paper. Let me just say that we've done a lot of market mobilization activities with Sarel. One time we went to a central bank and, being techies and business guys, we forgot our ties. We forgot how to suit up. So imagine me and Sarel trying to look for ties in the middle of the night so that we can attend a central bank meeting together. So we are good friends and I'm happy to be moderating this panel.
I think the previous conversation at least speaks a lot of the instances and challenges we've been facing, even though we have the designation, we have that little badge that says we're regulatory endorsed. I think it doesn't prevent or circumvent that we also face all the challenges that you guys mentioned just now. In saying that, hopefully everyone at some level is familiar with who BankServ is. There's a nice little description there, but ultimately we are the designated licensed PSO, so payment system operator for South Africa. We are the biggest and the oldest in Africa, though I don't know whether that means much with the rate of change and disruption in technology that we're experiencing. But at least it does provide some level of trust and credibility. I think we sometimes get referred to as plumbing, which is probably more apt that we sit behind all the financial services and only really get recognized if something goes wrong, which hopefully seldom happens. But as far as this relates to whether we're a digital public infrastructure, or in our case it'd probably be more apt to say digital public-private infrastructure, given our mutualization and the fact that we are owned by the banks and we serve the banks, which hopefully will change in the future. We still abide by the World Bank's definition or terminology of what a digital payments infrastructure is. So at least as the three pillars that we see at the bottom, it's identification, so being able to securely verify identities, transferring money, which is the payments one, and the data exchange, which is really making sure that transparency and data is captured between the governments and the businesses and the payments that flow. So at a glance, this is what we are, what we currently, our legacy is. What does it mean for the future? And really this is where we're going to pivot and try and evolve with the times and with the vehicles that we're going to talk about a little bit later, to say how do we play a more active and evolved role within cross-border and domestic payments, and more specifically instant or faster payments. So the vision there is ambitious, and I think it should be. We want to be the enabler for sustainable economic growth through inclusive payments. How do we get there? And that's the mission, and that's two sides to a coin. Sustainable payment solution really just means the market really wants it and uses it, but it's collaborative. It's not a build it, they will come scenario. We have to work with the markets, we have to work with the participants to define and design something that's fit for purpose. This is also not an either or, and it might be a little bit small there, but it's not to say we're going to either do the banked or the unbanked. It's converging and joining these two so that we serve a holistic, inclusive market. Ambitious, we know, but I think it's yet again a worthwhile endeavor. It might be just a point in time now to just say that it gives me a lot of encouragement to see in the discussions that we've been having up until now around these shared goals with everyone sitting in this room at least, as far as the inclusivity of payments and thinking about how do we solve these issues collectively, as opposed to how we can make money or how do we solve specific niches. So why did we choose faster payments, and really what's the link with the DPI and faster payments? I think it's worthwhile starting what's the link between financial services and financial inclusion. At a screenshot and a high level, and maybe to start with a common understanding of financial inclusion, this really relates to having access to and having use of widespread reasonable priced financial services. Underemphasized is that reasonably priced part. I think we really have to put that at the forefront, given, especially demographics, given the use and adoption risk that if we don't get that right. But that usually is what's referred to as financial inclusion. In saying that, it starts with a transaction account. You need a store of value, you need somewhere to receive and send payments. Transaction account can mean different things in different spheres and demographics and domestic jurisdictions, but ultimately that's your start point and also your gateway. If you look at that busy diagram there's a lot of tables in there. It might seem bleak if you think about this is the Global Financial Inclusion Index. But it might not be as bleak as some might say. I think there's a good base to work from. And the last point on the slide really is to say that maybe there's a success story or reference that we can use by way of the Asian and Latin American countries and saying, if you've got the digitally enabled financial systems, expediting and fast-tracking the inclusion becomes less of a hassle and a lot more expedient. So how to make this real, and I took Rob's lead to, from a regulatory point of view, and if you think public policy and public goals, it usually comes down to bottom line, it comes back to trade, it comes back to commercials. 1% increase in electronic payments usually results in a 0.1% GDP growth, which in itself is quite significant. A key enabler to how we see the electronic payments growing is the uptake of the mobile money, which is yet again something that we should not compete with, but absorb and use in all of our designs and solutioning. It's another vehicle, another attribute, a contribution factor that we can incorporate into our thinking and our solutioning. So that might be electronic payments and it might be financial inclusion, but really how do we get to the faster payments? And if you think about inclusivity, you usually think about the man on the street, what's practical, what are you competing against, and usually that is cash. So faster payments, by virtue, would be the base start point, at least from our perspective. There's a little bit of humor in there. I don't know, for those that don't know, that's the South African rugby player, and the little slogan there is faster than a debit order on payday. If you can get as fast as a winger in the South African rugby team, I think we can all go home and we've achieved the goal. But there is a debit order, which this is probably credit push. That's maybe the only distinction. So faster payments, known by multiple names: instant, real-time, near real-time, immediate, rapid payments. It all really speaks to the same thing: having funds immediately available, 24/7, 365. And the four real ways that this is linked to, and there's a bit of animation, but so everyone gets a spoiler alert. But the four real ways that you can link this to financial inclusion is the network effect. So as you entrench this into your environments, whether retail, business, or people, it really talks to having that stimulant or catalyst effect for being widespread, being ubiquitous, and then having the underserved or underbanked, firstly acknowledging and recognizing these as feasible and viable ways to transact, and then also hopefully having that stimulant effect that they'll also use it. Secondly, it needs to be low cost and immediate. I think that's the irrevocable as well, we can throw in there as well. So the same surety and trust that you would have from making a payment, making sure that it's immediately in your bank account or in your hand is effectively what's salient and relevant for end user. A faster payment system in itself, not as a service but as a holistic solution, should provide a level of competition and innovation. And this is what we've seen and experienced when we did our referencing and research. And that ultimately would create some level of market forces as well. The fourth one there is the enablement of other features that are complementary, and this is where you can see elements like the mobile apps, the QR codes, which really just ups the usability and the appeal at the commercial level, at a market level. So this is the 4 ways that you can really see it linked back into financial inclusion in the backdrop of still being a digital payment. And the quiet part out loud is, how does this compete against cash? Probably a number 9 that's not on this list is probably anonymity, in which case I think that's probably where faster payments would lose out. But there you can see comparatively, this is a really feasible way to start driving and getting towards the financial inclusion goals that we set for ourselves. So that includes settlement, includes availability, inclusivity, usability. If you think about the store and retail use, convenience, the consumer, so the security that's embedded that cash might not always have, the affordability factor, and then the spend control. If we think about what's the success factors that we have to consider when we did our designs for both TCIB and PayShap, it usually, and the Bank of International Settlement has a nice piece written about this, it usually comes down to these 4 domains. It's user-focused infrastructure, rules, and governance. In saying that, I know that the previous panel, and I share a lot of the sentiments around the regulators and their involvement, and either being a detractor or enabler. It is that you would need some level of ownership or backing at FPS level. Just from a governance perspective, I think it's difficult to get around it. But in saying that, there is some insights and learnings that the panel previously mentioned that it's worthwhile incorporating. So starting early, working with them, making sure you align to public goals will always be relevant. As far as participation, I think it's a non-negotiable that you have to include not the conventional banking role players, but increase that to the more unconventional non-bank PSPs and other elements or layers of participant. When you think about the participant model around your first mile, last mile, you have to include them in your rules and you have to include them in your base participant model. Last one is thinking about the use cases, how simple and easy this could be, and your links back into your cross-border. Keeping it simple for a consumer. The consumer does not need to know what the backend looks like, the multiple levels of integration, how settlement takes place. But really thinking about the use case and making it simple from one interface to send money wherever. So this is what we tried to do, or at least I think we've solved part of it, and we've got some successes that I'll lead into now. So it's a bit tongue-in-cheek to say the right vehicles. I think this is a bit biased. Banks have always, will say it's the right vehicles given that we've landed on them. But if you think about domestically from a PayShap perspective, there's a little timeline at the bottom. We started way back in 2017. This was ultimately, at that point, still termed RPP, which is Rapid Payments Program. And then ultimately the name changed into the service we know today as PayShap. And hopefully everyone in this room has a PayShap ID. If you do not, please get a PayShap ID and make your PayShap payments as speedily and quickly as possible. But it was an industry-led program. So as I mentioned up front, the idea that this is co-created holds a lot of value. As instead of hard selling or instead of pushing something and building something and hoping everyone will join. The intent was always the same. It needs to be real-time, low-cost, interoperable, and interoperable is extremely vital and core to both TCIB and PayShap. It also provided the stimulus and the platform or base for BankServAfrica to evolve into what we call BankServ 2.0, which is a platform business. And that also links back to your ISO 222 being message-rich and having that scheme capability, which is not mentioned there, but acting as a scheme. And I know scheme means different things to different people, but ultimately having that business management, governance, constitution, rule book elements embedded in your system as well, in your service as well. So, I don't know what happened to this slide, but I think it's worthwhile reflecting, and this is maybe indicative of what's different between what we knew as RTC, which is the real-time clearing that was launched in 2006. Whenever we have the conversation on PayShap, there's usually a question, but you guys have RTC, why do PayShap? And what that busy graph is trying to illustrate is PayShap was fairly steady and consistent over the last period. It was not in the traditional sense or in the conventional way of what we called faster payment systems solving for the base need. It was usually entrenched and embedded in a bank's service provisioning to its market and lost the let's call it added or complementary value that of the full bouquet would have had. So you can see that the PayShap is really increasing its volumes while RTC is staying consistent. So the overall uptake and uptick in faster payments has increased over the last 17 months since PayShap went live last year. You can see that there's 13 million unique users already in PayShap, which equates to 28% of the people over 15 in South Africa, which is a significant achievement and a significant success story. We know it's just a start and we need to build off it, but staying with the performance metrics of PayShap and the successes it's had over the last 17 months, there's just a high-level depiction. As we stand today, 48 billion rand has been processed, 76 million transactions, 4 million shop IDs, which is your unique identifier, which is usually your cell phone number, which makes it just easier yet again to not have the branch code in the bank name and the account number. It's just, you have to just remember the other person's cell phone number and then you're good to go. And this is just with the inaugural 10 participants. And the 10 participants you can see at the bottom, it's I want to say the usual culprits, but it's the bigger banks with the play within South Africa, and we've got the second tier or the next horizon of banks also joining. And ultimately, if we can get some traction at MPS Act and at regulation level, we'll see the non-banks in this space as well, which is where I think the biggest benefit and I would say snowball effect would reside. In the value proposition sense, this is what it safeguards and tries to achieve, and with providing this level of benefit. Currently, it's still 3,000 below transactions, which is the previous panelist accurately said, crawl, run, walk, or crawl, walk, run. I think this is the same sentiment. It's a lot to do with settlement risk, a lot to do with uptake and the effects this would have on the bank system. So you don't want to impose or create that level of risk up front. But in saying that, it's not going to stay at 3,000 Rand. I think there's other use cases and services that will also benefit from an instant payment service like PayShap, which we'll see that the value bands start increasing gradually over time. It's quick, easy, affordable. It needs to be safe and secure. The money is between banks and it's in real time. It's fast and final. It has to be 24/7. And then the Shap ID, as I mentioned, it makes it a lot simpler to start transacting between people as opposed to the conventional way. Yet again, that last point is probably the carrying of cash, which is a safety and security need, and this we hopefully see it in the uptick in the informal environments, which is ultimately our goal, which means the pie increase, the market increase. It's not just displacing or disintermediating existing markets, but really talking to a different use case. If we think about TCIB, which is a little bit, I would say, closer to my heart, given that I was part of the journey from inception, and I know that there's some level of sentiments, and everyone to some extent should be familiar with TCIB as a cross-border instant payment service within SADC. You'll see a lot of similarity along the design and the benefits and the value proposition. But ultimately, this was trying to solve. It was ideated and conceived within the regulatory structure. So there's some kudos and some commendament to the SADC and CCBG and the PSOC for starting this journey. But ultimately, as the previous panel mentioned, it's a longer journey than you usually would anticipate, especially if you go the multilateral route. If you go the scheme route, meaning single standard, but you get the scale, you get the adoption, that is ultimately the effect you're chasing or after. But in saying that, multilaterals take a lot longer than setting up bilaterals. It's worthwhile mentioning that the need and the requirement for the SADC region on a day-to-day basis is 8.4 million USD that's transacting, and that makes up even some countries a significant portion of their GDP, which is yet again just emphasizes and compounds the need for having cross-border systems and offerings that talk to real use and affordability and sustainability. Currently, SADC is still the most expensive, or if not or the most expensive remittance market globally. It's very cash dependent, which means there's a lot of cost and security and safety considerations when you think about moving cash between borders. There's fragmented market use through the PSPs, and there's a lot of closed loop offerings as well, which is costly. There's a lack of digital payments options, even if you think about the trade side of things. And the flows the need just keeps increasing. So you can see the flows projected to increase yet again by 4.2% in this year. The cost, if you had to put a quantitative figure next to it, for transactions 200 and less, you're sitting around 5.8, which jumped from 4.2 from the previous year. So it's really costly if you think about the need, the diaspora, the people that are making use of these offerings, and how costly that 5.8 really is. If you think about it in a yearly view, that's $54 billion worth of transactions in 23, a slight decrease. It can be for multiple reasons, but the statement holds true at the bottom. The need for cheaper, faster, seamless, and trusted cross-border payments in SADC is a need in SADC and a global need. So what is TCIB? And this, as I mentioned, you're going to see a lot of similarity between TCIB and PayShap. Probably the fundamental difference is the way in which the participant model is structured, and the fact that the duality or the cross-domain between bank and non-bank is already entrenched and involved in the active use of TCIB today. But a key distinction there is that top orange layer, which says we're integrating by making use and not disintermediating domestic infrastructure as well. So this means that a domestic scheme, a domestic ACH can integrate into TCIB, using that existing integrations into their environment at a domestic level with banks and non-banks and channels and usage to actually make access into a cross-border domain. And we are actively pursuing this. There's a couple of countries that are already part of a POC and a pilot to see how that could work. Alternatively, the direct integration still stands with banks, non-banks integrating into TCIB, while you can still make use of what we call PPSPs or integrators where the capability is lacking. So it's a lot of variations, but really what the essence of this diagram is showing, it's again that interoperability and collaborative nature of TCIB. It's not to disintermediate or compete or create closed loop silos. It's to make it possible and feasible for everyone to join, even at a level where commercial offerings that are existing can join into TCIB. So being the ocean, not the fish, is ultimately the end goal for TCIB. There's a couple of attributes to the right. It's just say it's real-time, low value, low cost, high volume. It's multi-currency enabled from a clearing perspective, but we are reliant on the SADC RTGS as a settlement component, which the countries will, as a central settlement capability, which the countries are still in a process or progress of getting their currencies onto the SADC RTGS. It's fully interoperable, as I mentioned, cross-domain, dynamic participant model, single infrastructure, so the cost and economies of scale should reside there. And it's member-led. So member-led comes back to the scheme notion of TCIB being not just a service or a clearing service, or it's broader and bigger. There's in the governance domain of how you position services, it's usually either a regulatory scheme, association-led scheme, or commercial scheme. By virtue of banks sitting where it's sitting and us being the business manager and scheme manager of TCIB, this ultimately provides us with a way to straddle all three. By way of having regulatory backing and ownership of TCIB, you get the inherent involvement and support. So getting into the previous panel, that's where we might have a little bit of a leg up, although sometimes I don't necessarily know if we're getting the bang for buck there. But then there's the portion of being commercially fit, so the sustainability and market fit still resides there. But the member-led portion of this is, I think, key, where as you become a participant and a member of TCIB, ultimately a say in what the value proposition overlays, service offerings, value-added services, disputes, working committees. It provides a level of platform where you can actually participate at that level and not being at the receiving end of whatever has been decided with a regulator or a service being pushed down. So it does provide you with that level of insight and decision-making authority. Where's TCIB today? We're sitting with 57 members across 11 countries. We've got 34 members in their onboarding stages. We're currently sitting with 7 active members, so it's yet again the crawl, walk, run scenario. And I'm also, it's good to note that this is significant, although I wouldn't say banks are the be-all and end-all of participation, but we have the recent activation of a significant bank within SADC, which really increased the use numbers on a day-to-day rate. And again, builds credibility and trust, inherent or implied credibility and trust. So some significant progress in recent months for TCIB, as well with PayShap. As I mentioned, I think that eventually the idea would be that we, from a BankServ perspective and from a regional perspective, there's some level of convergence between these two, as you would like to have the ability at a consumer level to send and receive not only domestic transactions immediately, but cross-border, SADC and beyond in the future. I won't necessarily belabor this, but the value proposition, as I mentioned, I think we touched on all of it. It's the fact that the regulators are on the same platform as you with the governance structures embedded in the scheme. So you're sitting with your SADC PSOC, which is represented from the 16 central banks. So you're sitting right next to the regulator you want to discuss certain topics and challenges and issues with. It is member-led, so you have that decision-making, and you have the authority and really the mandate to say what you want from the scheme and service. And ultimately, it's the compliance is embedded and entrenched, and then the operations is 24/7. So really trying to solve for the same need in the same markets as previously stated, but hopefully there's the opportunity to do this together. In saying that, I think the closing statement sort of captures exactly that. If you want to go fast, go alone. If you want to go far, together. I think this is true not even for the regulators and ourselves, but also for everyone sitting in this room with their own service offering and with their own solution. Thanks, everyone.
Thank you very much, Sarel. Please give him another round of applause. Both TCIB and PayShap are live. Actually, at one of the hackathons with Prof. Allen, one very smart gentleman was asking for PayShap APIs. So they're already thinking about how to integrate into PayShap. So thank you very much. We'll take questions if there are any. If not, we're happy to give you a few minutes back so you can go for lunch.
Thank you. My name's Charles Nias. It's been two interesting presentations, actually, and there's a lot of noise in my head at the moment. To kind of clarify it, and I know it's just my comments and lunch and some questions. So you know, history doesn't always repeat itself, but it often rhymes, you know. So if you look at the history in Africa over the last 20 years, you know, 20 years ago when it was in the card space, all the African countries had domestic card switches. And you had proprietary cards, and some weren't even part of the switch, and you had this whole fragmentation of card. Then Visa and MasterCard came along and basically started with international cards first, and then when the banks were used to using international cards, they said, hey, why are we running two things here? Let's just swap everything over to Visa and MasterCard. And it essentially killed all the proprietary businesses, and there were these inefficient domestic switches around. Some regulators tried to mandate, and they're still kind of around. So that's the card story, you know. So that's a payment story. And when we look at mobile phones, same story. 15 years ago, when you get on an aeroplane, you fly into a country, the first thing you do is turn your phone off, because receiving that GSM call was going to be so expensive, you didn't know what you're going to pay. You get home to this big surprise. Then over-the-top players come along, WhatsApp, and they start, you know, and then we all start making WhatsApp calls when we arrive in a country, and now we're all making domestic WhatsApp calls. So WhatsApp is killing the GSM business as well. So now we've got mobile phones and payments hanging together, you know. So now I look at this and I go, it's quite interesting actually, you know. If you look at now where Africa's going is, you know, this instant payment report, I think it's coming out in a week or two's time. I don't know what the number's going to be, but the end game is 52 or 54 domestic instant payment deployments across Africa. Then you go, okay, tick, now we're going to have proprietary instant payment deployments. South Africa's got PayShap, everyone's got their instant payment deployments. Then we go, well, surely we're creating the same friction we created in card and in GSM, and where's this all going to go? You know, and then I sit back and I look at these two and I go, well, simple. Some over-the-top player is going to come along and just destroy all of this, maybe use Interledger, whether it's now WhatsApp or WeChat or someone else with some sort of app, do that, and kind of then we're left with all these potentially defunct proprietary instant payment switches in the countries. Or BankServ sits back and goes, you know what, I'm already linked into 52 of these guys. I mean, there's technically no reason why BankServ can't launch PayShap domestically in every single country. So I'm sitting here going, who's going to win? And where's this all going to go? You know, so I don't know if that's a question or a statement, but it's going to be intriguing. That's what I want to say. Yeah.
My first question would be that I keep my strategy slides in here. But you're spot on. I think the idea is you're gonna sit with a little bit of a, not a dichotomy, but you're going to sit with existing legacy systems that are going to be fiercely protected from a domestic jurisdiction perspective. And it has to do with, I think the first panel mentioned it as well, it has to do with workforce and employment, transparency, relevance, all those things. Practically speaking, some countries will opt for, because it's just too costly to maintain and run their own domestic switches. So they'll opt for a solution like the one you just mentioned, where you have the deployment or reuse of something like a cross-border, and then you just have a single deployment of PayShap within that country. So I think it's going to be a journey, but you're quite right. Hopefully it's BankServ, and that's my bias hat again, where you'll have it, because then you'll have the inherent integration setup already existing. But it's going to be a journey because of the way they're going to defend and protect those. And there's going to be probably some compromise at some level where you're going to have ownership and governance and corporate governance arrangements that still make sense for the domestic jurisdiction. And that includes hard and sovereignty risks and all those considerations.
My question is around using PayShap without having a bank account. You mentioned how to have a PayShap ID, you have to create one with your bank. Most people already have cell phones that already reek it. They've already gone through the KYC process. A significant amount of people still use cash. They receive money through their cell phones and collect that money at retailers. Why do you not consider retailers as de facto banks? What are the thoughts and solutions around there?
So my question is about multiple regional systems. As you know, COMESA is currently in process of implementing a regional payment system. EAC is much further back on the road, but they are doing it too. And there is considerable membership overlap, as you know, between the various regional organizations. What's your view about how that will eventually play out?
Probably the most difficult question. I'll start with the first one. I think you hit the nail on the head from it's sort of what we're intending to do with the interoperability from PayShap perspective and running into a bit of regulation and sort of not that it's a dead stop, but figuring out ways to get the non-banks. Because ultimately, even if you think about the wallets we have today, there's a store of value that's a bank account that sits behind it. Some positive and favorable movement is elements like the COFI bill, which is the revision of the MPS Act, where they want to recognize how you get the non-banks into the financial services space, and that would include a review of wallets and who can hold them and what the store of value should be or should not be that sits behind them. Once that has been formalized, I think from a PayShap perspective, it becomes very simple to start absorbing and getting into those markets. Because you're quite right, if you just think about the amount and the reach that you would have inherently sitting with your MNOs, your large telcos and your large network carriers, it's a no-brainer from a use perspective and making it easy and simple, but with not necessarily having that cost involved and the schlep and the integration that sits with the banks as the store of value. So you're right, I think we're going to have a little bit of still dependency on the regulators changing and amending that. From a PayShap perspective, we're geared and ready to start absorbing it. On Michael's question, and I've thought about this a lot, because ultimately you'll have Pan-African, let's call it solutions like PAPs and similar offerings, which tries to solve for that you don't get stuck with region-to-region integration. I think you'll always be, the friction layer there is the governance, because of the way that the regions have partitioned themselves and they've got existing governance arrangements and structures and MOUs and arrangements with the banks. Technically, I would say even technically there's going to be some level of reconciliation and compromise that we'll have to do. If you think about distributed systems versus central systems, where does a rulebook reside, who's keeping the standard or making sure there's alignment between the standards across SLAs and settlement and whichever way you slice this. But even at a governance level, if we can get some level, and you get the African trade agreements that they can probably help with stimulating a lot of those conversations. But I don't see us getting around, we'll have to do it. I don't think there's a way in which we would not have, there's a way we can keep these siloed and hope for SWIFT or someone else to solve for how they transact between one another. So I don't necessarily have the answer to that question. I'm also looking and also hoping someone comes with a nice solution around, potentially there's a scheme of schemes that form some sort of level of integration between the different regions, or there's some way of reconciling at technical, operational, business, commercial, and regulatory level, how these regions, you can look at that overlap as potentially as bridging communities. That's another way to look at it, but that becomes a little bit sort of complex as well. But not necessarily a pretty answer to your question, Michael, but one worthwhile solving for.